How's it going, everybody? And welcome back to Continues to Tick. Here we are once again with the monthly dividend portfolio review. This is time, friends. It continues to pass, and I've been here on this journey for nearly 4 years now. It'll be 4 years next month. And if you've been here for the journey, friends, you've known it's been long, it's been mundane, but that's dividend investing. The exciting part happens slowly over time. And honestly, I think the most exciting part, probably in the future, when you know that you've been a few decades in and you can look back and thank your old younger self. But here we are, friends, for May 2024. This month, as you see it, will soon be over. But as always with these monthly dividend portfolio reviews, if you're new, we'll explain it. If you've been here a while, I'll remind you. I go a little bit more in depth than my normal every other week videos. In this one, for example, I'll tell you how much I fund my portfolio and how often. I'll go a little bit deeper into my sector allocations and percentages. I'll explain and show you some of my best and worst performers per each sector. We dive into that a little bit more. I'll also share with you my number of current holdings and my current portfolio's yield, as well as my current expense ratio. A lot of these you'll notice just don't change. The dividend yield does, but the number of holdings in my portfolio and my expense ratio typically don't. And that's because of my strategy. If you've been here for a while, you know what that is. And apart from that, I'll go into my current short and long-term plans for the portfolio. It's always important to plan ahead, think ahead. We are dividend investors after all, future-oriented thinkers. We are doing this for our future self, right? That passive stream of income is slowly getting shaped and built over time. And as always, friends, I tell you how much my dividend portfolio currently pays me in dividends. That's one of my most favorite parts. And then if you stick around, friends, you can use the timestamps down below to jump around. But at the very end, the topic for today's video, I'm going to discuss the future state of the economy on a macro scale. Not a micro scale, not the week to week, month to month, year to year, but just zooming out a little bit. Looking at the current state of the economy, I'm going to talk about a couple things, as you can see here. I'm not going to dive into that quite yet. Let's go into the portfolio first. As you can see, friends, we're still in the 80s here. We're at $84,854.40. And that's pretty crazy because if you've seen where we were last time, right, in the video, we were not here. And no, I did not change anything to my investing funding schedule. I still only invest $100 every week, but that is just how the markets have been moving. And honestly, since the very first time when I started this portfolio back in the year 2020, right, of July, that was right after the pandemic crash. Ever since then, the markets have just rebounded and have continued to go up. And it hasn't been a straight line, right? You could look at my graph here. You could see there are some moments here where there are some pretty big divots, right, along the way. Right? Some time-tested moments. But it's important every once in a while to look at the graph just to see how far it is that you've come, right? Look at me, for example, starting in July 2020 and in the very early stages. If you're new here, I used to invest $500 every single week. Slowly, life happened, job changes, going back to school to get my master's degree, focusing on career development, on individual and couples therapy, taking family trips. All this has happened. So in the moment right now, I've been taking a back step, right? Taking my foot off the gas slightly and have been changing it from $500 and decreasing it down over time. Right now, I'm at my bare minimum, $100 every single week, and I never plan to go lower than that. That's about $433 a month that I'm putting into this portfolio. But as you can see, friends, there were moments along this journey. I just kept funding into it, but the markets were going down for quite some time. Back in August 2023, it dipped quite a bit. Here in August, actually the year before, it dipped too. And then at some point, I actually did sell a $2,000 chunk to fund some, expenses to go to Greece. That was a very important life trip for my partner's mother, and I'm very happy we made that happen. But that is life, friends. And just a little update, right, on selling chunks of the portfolio for trips. If you caught my last week's video, or I guess my video 2 weeks ago, I did talk about potentially planning to sell a chunk of this portfolio to pay off a portion of a trip, right? To take now my family on one of their life trips, which is my mother and father's planned trip to go to Cancun, stay at a resort. But I decided ultimately to actually not sell a chunk of this portfolio to do that. Instead, I kind of played some tricks and we'll be all right. I just kind of spread out the payments over a couple months. It's kind of like a loan. I really didn't want to do this, but I actually just sat with myself, looked at it, and my portfolio is going to make me more money, over that course of time of actually paying that off than to just sell a chunk. Yeah, no, do I like pulling out another loan for that? But at this point, it's all fixed. The payments are. That money's better in my portfolio, as you can see, just based off how it's been performing just lately. And I'm going to get into that in my topic for this week's video, right? This craziness of the economy. Everything is just continuing to inflate. So stay in the game is my mindset. So no, I haven't sold a chunk. I'm going to keep it in and we're going to continue to roll. Continue to roll. But enough with that little tangent out the way, friends. Just to reiterate, this is the all-time return here, all-time view. And it says we have a money-weighted rate of return all-time at 51%. I'm not a big fan of seeing this money-weighted rate of return. If I take you guys over here to holdings, ultimately all-time, we have a 20.52% return, which is of $14,446.80. Yes, you get a little sneak peek at my number of positions, which is 51. If you're curious, we'll talk about that again here in a few moments. But my cost basis, $70,407.60. With the $14,000 gain, we sit at where we sit at 84.8. And that's it, friends. That is the sum right there. And then all time, let's just take a look at the sector allocations, right? So the best performer continues to be tech. As you know, I've been investing in this portfolio since July 2020, right? So one of the early, investments that I made, one of the early investments that I made was Nvidia. It was one along with all the other tech holdings that I had. None of them in particular at that time were just booming or roaring. Nvidia just happened to take off, with all the news recently of AI and all that, right? They were always known for their chips, but lately with AI, becoming more of a focal point in society, and every single year technology advancing, right, as quickly as it does, Nvidia has been on the forefront of that. I have been luckily on the receiving end of it, as a stockholder. It has a gain of 1,083%, which is insane. And then we have Oracle, IBM, Apple, Visa, Cisco. Apart from Nvidia, Oracle is actually my best second return, above Apple, above Visa. Just funny, huh? And that's how the markets move. I mean, sometimes you just don't know. That's why it's better to be diversified. But apart from tech, friends, energy follows as the next best gainer, financials, industrials, index fund, and it goes on and on. It looks like healthcare for me is still in the red. And then as far as telling you my actual sector, percentages, right? Real estate is my highest at 13%, followed by consumer staples at 12%, ETF at 10%, index fund at 10%. Tech is 10% of my portfolio pie, and utilities as well, followed by 9% at financials, 8% at industrials, healthcare at 7%, communications at 5%, energy at 3%, materials at 2%, and then consumer discretionary at 1%. And we'll just click on it because it's fun. It's literally just one holding, and it's McDonald's, up 37% all time, $145. Loving it. All right, I'll stop. But friends, this is just a general rundown of what it looks like. And if you're curious of how to take a closer look at my pie, right? You want to look at my real estate sector, for example. There's a link in my description box. You can click on it. I share it always in my description boxes, because I know when I first started this journey of being a dividend investor, it was always helpful just to get ideas of what people had in each sector, right? And, you don't have to copy me. I would advise you not to, do your own research, find, your tolerance level and invest within your tolerance level, your strategy, the pace at which you're trying to go, all that stuff. The main thing I would advise is just blue chip companies. Invest into those companies that have continued and have proven to pay a dividend for for many years, if not decades, right? Those companies that have been around. And oftentimes you'll know they've been around because they're boring. Just to put it blunt, these are boring companies, right? But making money over time isn't boring to me. And maybe as a dividend investor, you see it the same way. You know, if I had to be honest, friends, one of the main reasons why I eventually became a dividend investor is because I played with the penny stocks. I've played with growth investing. I've played with crypto. I've made money. I've lost money. I got done with all the psychological, emotional madness that came with investing with those strategies. This strategy of being a dividend investor, investing for the long term, buying and holding, dripping, right, these dividend payouts, this is my strategy now. And it's a lot less stressful, a lot easygoing. It's happening a lot more in the background of my life. And on the forefront of my life, I can focus on things that actually mean more to me. And especially knowing that mentally I have this going on in the background, it allows me to have more bandwidth to be present, right, in my day-to-day life. So I don't have to focus so much on my retirement planning. It just helps. It helps to live stress-free. Dividend investing, it's boring. It takes a long time, but it fits just perfectly into my life. And if any of that sounds enticing, maybe being a dividend investor is for you. I just figured it was important to mention that. It helps me to understand that, remind myself of that, especially when I see these hot stocks just pop off every once in a while. I'm like, no, I'm actually okay. I'll take my boring watching grass grow investing strategy. This way I can focus on life, focus on myself, my partner, career development, things in my day-to-day. Yeah, we'll leave it there. As far as activity, friends, let me just show you real quick, some of these recent dividend payouts. Like we said, we fund the portfolio $100 every week, technically every Friday. You can see the evidence here. And then just some dividend buys here. We had one here on May 17th, another on May 16th. But then we also have dividend payouts. We have Apple paying out $3. And just a little fun fact, just because we see it here, Apple was my very first dividend payout. It was 8 pennies back in the very beginning. I'd have to scroll way back just to see it, but just take my word for it. We went from 8 pennies to $3.18. It's a long way. Did take almost 4 years though. That's dividend investing. And then we also have a payout here from $10, Alliant Energy of $8, P&G of $9, and all these payouts here. Verizon $15, AT&T $15, JP Morgan Chase $14. It's always fun. I'm looking forward to the day in the future where I'm no longer working. Maybe I've stayed with the state long enough, I get a good pension. But apart from that, I'm getting these dividend payments and I get to use them. It's like getting paid just to hold these stocks, and man, that'll be nice. And then especially using those dividend payments to live my life, right? Not having to sell the principal, right? The parts of my portfolio that a lot of people have to sell when they have a 401k. I don't even have to touch it. I just live off my dividends. That is the dream. And let's look at the overall best performers, right? We talked about the sectors. So we already know Nvidia was the best performer. Here it says unrealized percentage gain of 592%. That's probably more accurate than what we saw with the 1,000 before, because that's a money weighted rate of return, I imagine. But apart from Nvidia, we have ExxonMobil, Aflac, Oracle, Chubb, and the list goes on and on. And now the worst performers, of course, we got Walgreens we have to talk about. I'm just holding on to it just a little bit longer. There's the new person in charge who's taking a little bit more of a different route. I just have to wait and see how it is that it plays out. I'm still waiting for it. They did have a dividend cut, and there's a couple things going on. It's pushing me in terms of, my own guidelines for my dividend portfolio. But for the meantime, I hold on. We'll see what happens. I really don't like selling. There's Walgreens everywhere. I'm keeping my close eye on this one. And then UGI above that one, a little less bad. Pfizer, a little less bad. And Verizon, a little less bad. So, but with the winners, there are losers. Everything can't be in the green. That would be impossible. So as far as my portfolio and how it goes, I will take my 20% return and run with it for now. No complaints. All right, now for a little bit more of the data, right, of the portfolio. These are the statistics. As you guys saw, the peak, right, 51 holdings. Why 51? I like being diversified. And I've always used like this metaphor, right, or this analogy. Like when you're younger, right, and your parents are always buying you new pairs of shoes all the time, right? Just wasting money for the most part, right? Yes, they're a little bit too big, but the idea is you're going to grow into it. That's how I look at my 51 holdings. My portfolio's not always going to be this size. One day I plan it to be $1 million plus in size, right? $1 million plus. So 51 holdings currently looks like a lot, but as you can see, it hasn't really been impacting my return, right? You can get real picky and say, oh, maybe it has or maybe it hasn't. I mean, it's hard to know. I just know I do have a pretty solid return, even with 51 holdings. In the future, 51 holdings for $1 million, maybe $2 million plus portfolio is not going to be that significant. It's actually going to be probably a really good thing to have that many holdings, right? Be diversified. I would rather be leaning more towards over diversification than under. I've been in this game for a little bit now, and despite how it moves, I've been pretty well padded. I haven't really seen too much of a decline in my portfolio, and if anything, I've followed the Dow Jones quite closely. So it's a good thing, I would say. But that may not work for everybody, but that does work for me. So I will say it like that. And as far as my dividend yield, it's 3.197%, right around 3.2. I'm totally cool with that. Anywhere between 3.8, maybe 3.3, 3.4, that is my comfort range. And as far as my expense ratio, it's very low, which is how I like it. For the most part, I do manage my own portfolio and I enjoy it. That's the reason why I do it. I enjoy setting this up, funding it myself, keeping eyes on it every week, and just seeing how my strategy, right, how my choice of picking is playing out. I enjoy it. Some people want to give it to someone else, and that's fine. You know, my expense ratio is still there, right? It's not zero, but it's 0.01%. So now let's talk about some of the short and long-term plans for the portfolio. So on the short term, like I mentioned, I'm not planning to sell a chunk of my portfolio, to go to that life trip with my family. That was something I was pondering, and I ultimately decided to not do it, right? I have easy payments set up instead. We'll see how that plays out. If it's a bad decision, it's a life lesson. If it works out, even better. That's on the short term. In addition to the short term, my plan is just to continue to invest $100 every single week. As some of you may know, right, you've been following this journey, some of these videos for a little bit now. I am expecting a job promotion, right, coming up probably sooner rather than later. There might even be a chance that, on my next video, I already have a start date. And that would be crazy because I've been waiting for this job opportunity since January of this year. Yes, January. So it's been a long time coming, right? The positive is it's a promotion. It's a stepping stone for a solid job in the future that I really want to get that will lead to significant more money. The downside to it is that despite it being a promotion, I am going to take a pay cut, which is one of the reasons why I've been trying to financially, look at my field, right? I lowered my dividend investing fund to $100 a week. That was in preparation for this, pay cut that I'm going to take, and, not paying for this trip out of pocket and instead using easy payments and not selling my portfolio. Those were things that I've also taken into account in terms of this job cut, or in terms of this pay cut, coming up. Where I'm at, where I sit, this is how I'm going to continue at least for the rest of this year, $100 every week funding. And this is the short term for now, with no plans to change this. I just want to hold on to what I currently have going for me. And as far as the long-term plans are still the same. I want to retire comfortably by the age of 52 or 50. If it could be sooner than that, even better. Who knows what life looks like at that point if I'm still around. I hope I can still be around. I want to comfortably retire. And that means hopefully have a good house I like, a car I like, be able to take trips and travel, stuff like that. So that is the idea. And here we are, friends, for one of my favorite parts. It's how much my dividend portfolio currently pays me in dividends. So let's take a look. So as you can see, we're at $84,854.41, which is practically the same as my portfolio as it sits today. If we take a look, the annual dividend income is currently $2,436.36. And if you break this down into the monthly, it's $203 a month. Into the daily, it's $6.67. And it says my current yield, according to this app, which is the Div Tracker app, if you're curious, it's 2.87%. We saw on M1 Finance, it was around 3.19, if I can recall. Here it says 2.87. Who do we believe? Well, I likely lean closer to M1, right? I also don't know. It could be somewhere in between. And that's typically how I look at it. And as long as it's somewhere in between, I'm totally fine with that. You could already see here my annual dividend income with a yield of 2.87% is $2,436. And I'm going to roll with this tracker for now. So until the day we hit 2.5 on this tracker, that's when I'll say I hit the goal, right? And it looks like we're 97% reached, and we just need to invest $1,839 more at this yield to reach that goal. That is the next objective right there, $2,500 in dividends. We'll get there. We will get there. All right, friends. So let's go to the topic for today's video, right? In this video, I want to talk about the future state of the economy on a macro scale. I have a couple topics within this topic that I want to just touch on briefly, right? The first one, the gap widens. The second one, you need to play. Dividends are easy. The goal, I put the trap here. So let's talk about them one by one. So the gap widens, right? Let's take a step back, right? The way I look at the economy, friends, you could look around you. I live in California. What I notice is there's a lot more homeless people. And what I also notice is that the cost of living, the cost of groceries, the cost of food continues to go up. I make a good amount of money right now working for the state prison as an RN. And for some reason, I feel more broke. And I make good money. I can only imagine for the people that don't make good money. They are probably feeling very broke, very compromised in their ability to fund a lifestyle. So much so, I imagine a lot of these people eventually give up, right? This is how a lot of people are becoming homeless. Sure, some people could argue it's the habits, it's a choice. However, right? But if you really look at it, right, and you want to be sensitive, you can see that the game has just continued to get harder. The gap is widening. The gap between being completely broke and homeless to being very wealthy, right, is like widening. And like I said, I make a good amount of money being in the middle class. And I even feel like my purchasing power has decreased. Sure, like I'm trying to invest for the future and do it all smart, right, in the right way, in my opinion, right? Saving for retirement, not buying a BMW, not buying that Jeep Wrangler Rubicon when I want to, buying a Toyota Camry instead, But jokes aside, right, I'm trying to do this the smart way. And I still can't buy a home in a smart way. And I've been in the workforce for 5 years, right? Yes, I have quite a bit in my dividend portfolio. People could be like, Jesse, stop whining. You have money there. That's your house down payment. Sure, I can see that. But that's me, and I make good money, right? That's why I say I make good money for where I'm at in the middle class. But like I said a few videos ago, $80,000 down payment isn't even enough to get myself into the house that I'm currently renting right now, which I mentioned before, it's cheaper for me to rent the home that I'm in than to buy it, right? My down payment would be more than what I have in my dividends currently. And that is with a 20% return, which you saw. So let alone the cash that I had on hand of $70,000, that wouldn't even be enough. This market is pretty wild right now. That gap between broken homeless to wealthy and ultra wealthy is continuing to widen. And the people that are suffering are us in the middle class. And some people towards the lower side of the middle class are just giving up, right? They're just giving up and going into the lower class and then giving up more and going homeless. And then you have people that are really like myself trying to strive, right, for something greater. And we're just noticing our purchasing power decrease despite how much we're trying, right? Like I became an RN to make good money, and I still feel like I can't even live the life that I want to live quite yet. And sure, it's only been 5 years. Some of you may say, Jesse, slow down, take a step back, just analyze. That is what I'm doing. I'm analyzing my situation and keeping eyes on the horizon for where it is I want to go. I'm not in a rush. I'm trying to play it safe, trying to play it smart. Like I said, I'm not buying that Jeep. I'm not buying a house I can't afford yet. I'm saving for retirement. I'm putting more into career development. Like I'm doing this the smart way, right? The wise way, in my opinion. But not everybody's going to do it this way. It really only takes one bad decision at this point to take people out. And a lot of people are buying cars with payment plans, right? Of monthly payment plans of like 72 months. I think I saw a statistic the other day that like a lot of people are getting these. And that's insane. And that's being normalized. So on the macro scale, I see the gap continuing to widen. I just don't see it coming closer again. And that's a scary thought. That's a scary thought when the people who have money are going to continue to get more money, and the people that are leaning to being broke are just going to get more broke because they can't afford a lifestyle anymore. And then maybe one or two bad decisions take them out completely, when in the past we were able to make a couple bad money decisions and we would still stay afloat, right? Everyone's just taking on more and more debt. It's been more normalized to take out debt, which is crazy. I mean, you saw me. I just took out a easy payments plan to pay off my trip, right? But I'm trying to leverage it. But maybe I'm no different. But here's the next one, friends. You need to play. And this is something I've touched on every now and again, is this idea, right, of seeing on a macro scale that you have to be a player in the game. Like I said, it almost seems like the people making money are making more money. But people who invest, you know it takes money to make money, right? You put your money to work for you. People like us that invest, we know this. People that think about investing, you will learn this. It takes money to make money, but you also have to be in the game. You put your dollars to play, and they're going to be working hard for you. They'll bring you some dollars, some pennies, and it'll all eventually stack upon itself. That's how you do it. That's how you invest, right? You need to play. This is the game. And for the people who aren't investing, for the people who aren't putting their dollars to work, they're significantly, with inflation, losing purchasing power. So my advice is get in the game, right? And this leads me to my third point. Like, this is why it's even easier now, and probably even better, to become a dividend investor. I don't know if it's going to gain popularity or not. The barrier to entry for dividends is really low, right? You could do it at home, do it on your laptop. Super easy. Just do your research, be smart about it, be wise. There's a lot of people on YouTube to follow. They give you I'm just here to tell you a story, just from my perspective, right? Give you maybe something to compare yourself to in a good or bad way. It doesn't bother me, right? Right? I want you guys to do better than me. But if nothing else, I want you just to see my journey unfold over time and see that is all. I just want you to see that it's worth it. So I wrote dividends are easy because the barrier to entry is easy. You don't have to buy a house if you can't afford it. Get REITs. You get stock appreciation. You also get dividend payouts. You can drip the dividend payments. These are all things you can do, right? So if you're not a player, consider being a dividend investor. You don't have to be only a dividend investor, but in your portfolio, along with your growth investments, have some dividends. But at the very least, what I'm trying to say is, don't allow this gap to take you out. Be a player in the game, and think of dividends because the barrier to entry is so low, you can do it literally right now. And here for this last one, friends, I just want to talk on the question, like, what is the goal? What is the goal right now on the macro scale of the economy? I mean, the good thing is it's a selfish reason, but at least when I think about it for myself, just thinking of this question, there's a lot of sadness that comes with this, because the ultimate goal, I don't even know if it's the goal, but the outcome, I should say, I'm seeing is an economy that's taking a slow downturn for the worst. And it's very sad to see. It hasn't impacted me directly quite yet, because because I'm pretty padded in the middle. I'm like I said, I'm trying to do the right things, focus on my future, make smart financial decisions. But it's taken a lot of people out already, and that's sad. So the goal is, I think, just to survive, right? To avoid the trap, that financial trap of making those bad decisions. And like, if you could do this and hold on to that over time, you'll probably be okay. But you have to be more mindful than you've ever had to be. You can't just mindlessly spend, mindlessly make decisions, because you're going to find yourself in a corner. And on the macro scale over time, I see a lot of people getting taken out. A lot of people will go into the debt. The whole country's in debt. Individuals will be in debt just the same. And I don't know if at any point people are going to come to collect. I don't know. I think maybe as long as you're making minimum payments after minimum payments and you can survive on that, you might just be okay. But I see a lot of people going into debt and probably just making minimum payments. That's on the macro scale. It's like you can overspend, and as long as you can make your minimum payments on your daily, monthly expenditures, then you're okay. And that's insane to me, because so I guess that's a different game, I should say. So the goal, friends, right? Let's take some of this darkness. The goal is to survive. It's always been to survive, but it almost seems like it's harder to survive now than it has ever been. And in a couple decades from now, I imagine it's only going to get harder. And just like it takes less decisions now to take people out financially, I think it's only going to continue to lean that way. So be very careful. Avoid the trap of debt. But as you see, even in myself, it's easy. So easy to just say, this trip, I'm going to split into payments. We're all going to be part of it maybe at some point on the macro scale, because to continue to live a life that we want to live, we might have to lean into that. I mean, the whole country's in that right now. Trillions of dollars in debt. I'll leave it there, but I just wanted to play on this topic, touch on it for a little bit. A little bit of a dark way to end the video, but just some thoughts, right? But that is just the macro scale that I see of the future of the economy. So I think it's worth mentioning. We'll see how it ultimately plays out. I'm going to be on this YouTube channel as long as YouTube's here, continuing to document this journey of being a dividend investor, showing you this journey, and hopefully over time showing you that it's worth it. That is the ultimate goal for me and my channel here, is just to give you an example of a dividend investor, and one that shows you it is worth it. So hopefully it'll continue to be worth it, friends. I'll see you guys on the next video. This was the portfolio review for May. As always, friends, time continues to pass. Take advantage of it, and I'll see you on the next one.